Good Thursday afternoon, investors and traders, and welcome to Finom Group's weekly State of the Market. I am your host, Seth Golden. Let's dive right in on things here. Everyone has the brain power to make money in stocks. Not everybody has the stomach. That's a famous quote from Peter Lynch, essentially, pointing to the fact that the opportunity is always there for you to make money in the stock market, investing, trading, but not everybody has the intestinal fortitude, as I like to say, to stomach the drawdowns, the volatility, the price that you actually pay to achieve those returns. This chart right here, remember, we're just off the all-time highs here today on Thursday. We got up to 44.23, all-time high in the S&P 500 is 44.29. The NASDAQ has made another new all-time high here today, folks. August 5th, the NASDAQ has made another new all-time high. The chart that we're looking at here, basically, there's this common belief amongst investors and traders that it's not a good idea to buy at all-time highs. Now, let's just step back for a moment and think about this for a second. The S&P 500 has made 41 or 42 new all-time highs this year. I think this is like number 15 or 16 for the NASDAQ, which means if you had bought the first all-time high, the market has continued higher. But if you needed the actual data and a reminder, given that it's just so prevalent that investors believe buying the all-time high is a bad idea, you should wait for a dip, a pullback, a correct. Well, by the way, we still are without a 5% correction on day, I want to say 188 here, 188 trading days without a 5% correction. You would be waiting that long, seriously. So the chart shows you the highlighted invest at all-time highs, which is the dark shaded areas here. 1 year later, if you had invested in the all-time high versus any other time, you would have had a greater return investing at the all-time highs 1 year later, 3 years later, 5 years later. Again, a lot of the things that we think are actually a disciplined approach to investing or allocating, they're just common sayings. They sound smart, but the practicality of them is anything but. You're putting yourself at a disadvantage investing any other time than at the all-time highs. We've talked a lot about seasonality in our weekly research report, as well as past state of the market. So just kind of putting a simplistic bar chart here in front of you, showing you where we are so far as coming out of July and into August, the frequency of the S&P 500 price gains in August. Now, we know August tends to be an abysmal month when it comes to returns for investors. We already know that, but this is another way of looking at it. All August, every month of August, going all the way back to 1945. So every year, every August, going back to 1945, the S&P 500 gains only 55% of the time. So it's kind of a coin flip. It's either, 50-50 chance, basically, just above 50-50 chance. But what about after new highs were achieved in July? Well, the probabilities get worse for returns in the S&P 500 if July was an all-time high going into August. You only have a 35% chance that August is actually positive for the S&P 500. What about when the S&P 500 has 6+ new highs in July, which, by the way, it did. It had 7. Now you're looking at only an 8% probability that the month of August will be positive. It's just not looking good, folks. Keep in mind, we're looking at not just seasonality factors, but quantitative factors when we put together this particular bar chart. It's giving you both the seasonality, which is just, August, but some quant data mixed in. In that sense, you're combining various quantitative data sets to give you a higher degree of what we might anticipate from the S&P 500 in August, keeping in mind that the seasonality factors at the very least have been bucked by this year's trend. And we'll get into a little bit more of the seasonality towards the end of this week's State of the Market. Since 1950, the S&P 500 has never risen in the month of August after making 7 or more record highs in July. Now, this goes back to 1945. Now we're just starting at 1950. Guess how many records S&P 500 notched in last month, July? It was 7. So if you just start in July as opposed to 1945, there's no possibility. Historically, there's no probability that August is positive. But we'll see. We'll see how this plays out. This chart, really good chart here from Andrew Thrasher, Thrasher Analytics. I like the way he looks at certain breadth in the market, certain momentum factors in the market, and puts it on a chart for us. What we see in the top panel here is the S&P 500 and its 50-day moving average. And you'll notice, we've touched even, breached the 50-day moving average going all the way back to September of last year, but it's proven supportive, that 50-day moving average, all the way up into the most recent month of July, where we once again touched the 50-day moving average and bounced above it. But the bottom panel here shows that for each successive bounce off that 50-day moving average, we've had a lesser gain. Each time we bounced off of it, here was probably the biggest, but then a lesser one, lesser. We're not getting, once we are bouncing and it's finding the support, the S&P 500 is only making, insignificant new highs, if you will. It's a very steady and progressive trend higher. We're not getting like these 2 and 3% bounces immediately off that 50-day moving average. Is that impactful? Is that meaningful? Is it actionable? Not necessarily. Not necessarily. It's interesting. I just find it interesting. It won't mean anything until it means anything. And when we'll know that? In hindsight. Everything that we look at in the way of charts, in the way of breadth metrics, they're developing stories, but they don't necessarily forecast the future. It's interesting. It may not be altogether actionable. And talking about stocks above the 50-day moving average, this is a chart here from Bespoke Investment Group, and it also shows the percentage of stocks trading above their 50-day moving average within the individual sectors. And we can see stocks trading with the greatest percent above their 50-day moving average is here in the utilities, then healthcare, which had a really strong month last month, as well as real estate. Both of those led the S&P 500 in terms of total returns for the month of July. There you have technology, consumer discretionary. What's really lagging is communication services, consumer staples, financials, and materials. Keeping in mind, materials tend to have a bad month. When it comes to the percent positivity rate going all the way back to 2002, materials has the worst positivity rate, meaning it's higher in the month of August. It has the worst positivity rate of all sectors in the month of August. Having said that, all of this about, the different sectors and their percentage of stocks trading above the 50-day moving average, sentiment remains relatively positive for equities, regardless of the duration between larger drawdowns in the S&P 500. As I said earlier, the S&P has gone now 188 trading days without a 5% pullback. Keeping in mind, the mean number of trading days without a 5% pullback is just 104. We're almost double the mean. Does that mean that we're due for a correction of 5%? As I've often said before, there's no schedule for the S&P 500. It's not clocking in and clocking out like we do as workers, if you will. There's no schedule. What you should recognize by that particular statistic And the fact that, we really can't find even 2 consecutive days where we've closed and stayed below the 50-day moving average. So we have not had 2 consecutive closing days below the 50-day moving average. We have not had a 5% correction in over 188 trading days now. Today will mark, I think, 189. It tells you something about fund flows, about overall sentiment in the market for the future economic growth, which leads to earnings growth. This tweet from Liz Ann Saunders just this week. She's basically tweeting out the sell side indicator from Bank of America, which tracks strategists' average recommendation equity allocation, still near closest level to sell threshold since 2007, right? Essentially a sell signal, right? They take a survey or whatnot of the different strategists when it comes to what they're recommending so far as asset allocation. And based on the respondents, they've created this graph whereby if it's at a certain level, it issues a sell signal. And if it's at a low level, it issues a buy signal. Right now, this bull bear indicator is at its highest sell signal since 2007. Here's how this is my take on it. There's always a lot of noise produced in the analyst and financial media communities when drawdowns of any great consequence are few and far between. So naturally, we've gone 188 days without a drawdown, right? So it serves to figure that analysts and strategists are kind of antsy. They don't want investors getting out over their skis, being over leveraged, going this long without a meaningful correction. So this bull bear indicator has been screaming a sell signal now for several months here in 2021. I personally don't believe in the existence of a sell signal, given the natural primary trend of markets being up. What does that really mean? In other words, if the market travels higher over time, like if that's the only thing that the market can do, either because it's structurally rebalanced to do so, weeding out the crap and putting in the good stocks that, have strong earnings. So either through structural rebalancing or just a general long-term trend in earnings growth, the market goes higher over time with intermittent drawdowns. Those drawdowns are just buy signals. They're just better buying opportunities since the market trends higher over time. That's why I don't believe in sell signals. I believe the only reason the word sell signal or the phrasing sell signal exists is that just to have an antonym for buy signal, really. Selling has little to nothing to do with some arbitrary, sentiment offering like this. Now, keep in mind, this is just this week from Liz Ann Saunders, right? Just this week. And here, the same sell side indicator that was February 28th. It was still issuing a sell signal back then. Imagine if he had sold back then. Well, you missed out on a 16% S&P 500 rally. Is this a signal? Or is this just noise? It's really just noise. Here we were in February. Here we are with the latest one. It's noise, folks. People like to sound smart. They put up these fancy charts. They take these surveys and stick to your long-term game plan. This is just an echo chamber of nonsense. Let's see. It's more sentiment, if you will. I'm not a big fan of sentiment data, but I do like to make sure I have a broad sense of what's going on in the investor community. This chart above, this is the TD Ameritrade IMX Investor Movement Index. It comes out every month. And the IMX is based off of actual broker. I like this one better because it's actual brokerage accounts by retail traders at TD Ameritrade. This seems like a very good measure of sentiment amongst the retail crowd as it tracks stocks that they're buying and selling rather than some arbitrary survey on how they're feeling about the market. Unlike investment managers, these retail traders are showing extreme optimism right now. The IMX reading clocked in above 9 for the first time in the most recent report, which is above where it was back here going into 2018. That makes people nervous because we know what happened in the first quarter of 2018. We had a nice, I say nice, because you expect a 10% correction at some point. We got a 12 to 13% correction from February through April of 2018. So again, indeed, and this was a time period also when we went from late 2016 into 2018 without a 5% correction. In fact, this was either the first or second longest period in history without a 5% correction. We didn't even have a 3% correction until February 5th of 2018. Something to be aware of. The higher we climb without a meaningful correction, when it does appear, and you won't know it's going to be that meaningful correction. You're not going to know, oh, okay, it's here. There's not really going to be an alarm bell. It's just going to fall further than people have recently aligned themselves with the trend of smaller drawdowns. So do be aware that that is a tendency of the market. The longer we go without a meaningful correction, when it does arrive, you have that meaningful correction. You just don't know when it's going to happen. Sentiment, price, the further that we do climb and kind of overshoot the strategist and analyst price targets this year, you start to see new price targets or revised price targets. Just this morning, Goldman Sachs raised its year-end price target for the S&P 500. It took its price target for the benchmark index to 4,700 from 4,300. They also took their 2022 price target up to 4,900, as you can see right there. Price changes sentiment. These analysts have been behind, they've been wrong. There's really no two ways to say it. You're revising your price target because you undershot. I undershot here for Finom Group. Our price target for this year was 43.25. We undershot. I mean, it's still a 15% gain for the S&P 500, and at the time we were, one of the higher firms on the street. Now, there may have been 3 or 4 with the price target above 4,200. So we're completely, satisfied with achieving the price target, but indeed, we undershot. We're revising our 12-month price target. Several other firms have already done so. JP Morgan revised theirs from 4,400 to 4,600. Oppenheimer just a couple of days ago, 4,300 to 4,700. Cornerstone Macro, 4,300 to 4,601. And they basically were just trying to get above Fundstrat, 4,400 to 4,600. There's Goldman Sachs and Credit Suisse, 4,300 to 4,600. Does that mean just because these, strategist price targets were already hit that we'll once again hit them by the end of this year? They're revised? No, absolutely not. That is not what it means. It just means that they're looking at the probabilities, and the probabilities suggest higher price targets. The S&P 500, could hit a higher price level by the end of the year, and they're supporting it with their earnings outlook, keeping in mind that earnings just continue to trend higher above any analyst estimates. This is kind of interesting. So the SPY, or the S&P 500 Index ETF, post an outside day both today and yesterday. Buy on the close, sell X amount. This is from Quantifiable Edge. Monday of this week followed last Friday's declines. Okay, so if we look at the chart of the S&P 500, here's Monday, right? This was last Friday, down day, followed by, some more price pressure on the S&P 500. And then here was Tuesday. Here's Tuesday. And what's interesting about Tuesday is we made a lower low. So we were lower than the low here on Monday, but we also made a higher high than Monday. A lower low and a higher high results in an outside reversal day. And it's rare, an outside day is a day where the security or the index makes a higher high and a lower low than the previous day. And so once again, if we look at, here was Monday, you can see off to the left side of the chart, the intraday high was 44.22. The intraday low was 43.87. Now we'll go to Tuesday. Look at the high. It was only 1 point higher, but it was still a higher high. And the low was 10 points lower than the previous day. So there's a big outside reversal day there. And it's only happened 28 times in the past, going back to 1993. So we look at the 5-day returns, most of the gains come by the fourth day. Within the 4 trading days that follow that outside day, you tend to have pretty good probabilistic returns. In the 28 times this has happened since 1993, 4 days later, the market has been up 23 times and only down 5 times. 3 days later, it's up 21 times, only down 7 times. Same thing with 5 days later. It's been up 21 times, down 7 times. It's an interesting statistic for sure. Today we are having a bounce back day. Wednesday was another down day. It's been a very choppy week here. Down Monday, up Tuesday, down Wednesday, possibly up again here today. So looking just above and beyond, the index seasonality, what are the worst S&P 500 stocks in the month of August going back 10 years? And so here's a list of those stocks. A lot of them are energy names: oil and equipment, oil and equipment, oil and gas, oil and gas, oil and equipment, oil and gas, oil and gas. There's a lot of energy names on here that are, just the worst stocks to own this time of the year. AT&T is another one, pretty bad. Here's what is this? Walgreens Boots Alliance is another one that underperforms. Another big name you might be familiar with there. So these are the worst stocks to own in the month of August going back 10 years. We spoke about seasonality within the context of the S&P 500. And we've looked at this chart before. I like this composite cycle index. Why? Because it does blend a lot of seasonal factors together. It blends and it's an equal weight. It's looking at an equal weight S&P 500. It has the 1-year seasonal cycle, has a 4-year presidential cycle, and a 10-year decennial cycle. This is nothing new. We've looked at this before. Now, it shows that here's August, folks, and we tend to fall off here until about October or the fourth quarter, where we start a rally into what is known as the best 6 months of the year to own stocks, November through April. Those are the best returns going all the way back to 1950. Going all the way back to 1950, November through April, the best 6 months of the year to own stocks. But again, we tend to fall off here in August based on the cycle composite index for the S&P 500. However, and I said this just before, The market has bucked a lot of the seasonal patterns here this year. There's the two most powerful forces in the market are liquidity and fund flows. What do we know about 2021? It has record inflows to the market. If we go back to June, here's June right here, folks. Look at the swoon that we were supposed to have in June. It never materialized. Again, I think one of the factors, one of the reasons why the cycle composite index to date, just to date, has not really materialized, history has not repeated, if you will, is because the fund flows have overpowered the seasonal tendencies of the market. Will that continue here in August? Remains to be seen. Market tends to tip over or hit its, intra-year peak in the August time period, or it tends to correct in the August time period. And the specific date is August 4th, yesterday. And we did roll over yesterday. So it remains to be seen. Keep an open mind, be flexible, have a game plan of what to do. That's the bottom line. None of this should worry you. The chart like this where you see things, it shouldn't concern you if you've got a game plan that addresses, if the market corrects and if it doesn't to any significant degree. You should have a game plan that tackles both of those opportunities. I say opportunity because when cheaper prices arrive, that's an opportunity in a bull market where earnings are still growing, where credit spreads remain very tight in an economic expansion cycle, and we don't have an inverted yield curve. Those are your buy the dip indicators. Make it happen. This shows right here, peaks in early August are normal with a new party in power. Again, specifically August 4th. More than likely, if we do have a meaningful correction here in August, maybe through September even, it's probably going to come with some volatility as well. The average VIX change by month, going all the way back to the origination of the VIX, 1990, tends to be August, has the biggest rate of change from month to month, 9.4% climb from July. And when you're talking about just monthly spikes, again, August has the most spikes within the month in the VIX, 12 there, on average, going all the way back to 1990. Again, it's just about having the right expectations. This data helps us to, have an appropriate understanding and expectation for market performance going forward. We can game plan with this data. History does not always repeat. And remember also, last year the market was up in August. Last year the market was higher. So history did not repeat back then. This tweet, just from earlier this week, I created this tweet. It's another reminder to investors. Your goals are not somebody else's goals, and therefore you shouldn't measure your goals by what other people are doing with their assets and how they're managing their portfolio. Never base your portfolio actions on actions of others. You don't know when they began their investment. You don't know their motivation for selling or taking profits. Your thesis and goals should be elevated above the unknowables of other people. And I hearken, the reason why I kind of revisited this because, Apple recently hit all-time highs before it released earnings. It's been chopping around since, but it's still pretty close to its all-time highs. We've been long Apple since going back to March, and we've been trading and building a core position going all the way back to like the 1-teens, 117, 118, 119 in shares of Apple. And in the face of, Kathy Woods, right? A high profile fund manager, Kathy Woods from the ARK Investments, she was selling her holdings in Apple, here was a tweet back in early May. Now, the price in Apple back then was 123, 124. It hadn't done a whole lot since we started trading it even. Did that keep us from building our position in Apple? Suggesting it in recent research reports that we thought it had good potential for the full year? No, I didn't care. I don't care what Cathie Woods is doing, let alone any other fund manager. I was a sell-side analyst for many years, covering shares of Apple and other consumer goods, consumer packaged goods. I knew my thesis. My thesis was what mattered. Could I have been wrong? Absolutely. Absolutely. But that's not correlated to anything Cathie Woods is doing or any other fund manager. My goals did not align with what she was doing back then. My thesis said to continue to accumulate and grow the position over time. And it has worked out quite well. We talked about what are the worst stocks to own for the month of August. Here are the best stocks going back 10 years to own for the month of August. And you'll see, you got NVIDIA here, Take-Two, Humana, AMZN is one of average return. Here's the top tier up here. One that is on the list also, look down here. I'm sorry, there's some, I guess it's not in very good order there. But look at Apple. 6.64% return on average over the last 10 years in the month of August. CRM, which is Salesforce.com. You got a lot of tech and software components and healthcare in this particular list here, obviously. But there's Apple, folks. The percent positive rate, that's also very critical to us. It's one thing if it has a good average, but if it's because it grew for whatever reason, 20% one year, and fell maybe 10% on another particular year in the month of August, then, the averages don't mean a lot to us when it comes to the median or average return. But the percent positive rate gives us a lot more meat on the bone, if you will, when we consider what we're doing with our long-term holdings and potentially trading around that long-term holding as well. Scalp trades and swing trades to just further benefit your cost average. So good list there to consider. Again, that's from Schaefer Analytics as well. And it's not like, it's been easy. If you traded the tech stocks this year or considered buying them as a long-term hold in your portfolio, it hasn't been easy. But as I often say, those who are unwilling to accept double-digit drawdowns are less likely to receive double-digit returns. Like, if you think about it, it's logical. If you don't have the intestinal fortitude to stomach a double-digit drawdown, how do you expect to have a discipline to ride up to and through a double-digit return? Like the two, So keep that in mind. And again, I could go all the way back, here to our research report on March 14th, when we talked about these names, some of these FANG names like Apple here. On Wednesday, I bought the Golden Capital Portfolio starter position in Amazon too. We did fantastic with Amazon, from sub 3,000 to 3,600 plus with a July call July call option, sorry. Apple, Golden Capital Portfolio is already long Apple. Our 6 to 12 month price objective for Amazon is 4,100, and that looks troubled right now. And Apple is 161. It doesn't really, if it gets to 161, it gets to 161. Our cost average is all the way back down there in the 1-teens. We're fine. We got out, we took our profit on the Amazon. I'm ready to reload Amazon, folks. Like that report, and for those of you who read our weekly research report, I mean, you know the deal. The company still grew its earnings. You know how this movie plays out with Amazon. It has a big fall. This is nothing new. We've seen this before in Amazon. This movie is just replaying. And that's what this chart basically shows. Going all the way back, to like 1990, the dot-com era, these are the Amazon maximum intra-year drawdowns. 83%, 73%, 37, 41, 46, 64, a lot of 30s, a lot of double digits. That's the point. Amazon does a double-digit drawdowns, like it's drinking soup. An old man drinks soup, if you will. The average intra-year decline for Amazon is 33%. The average yearly decline is 33% for Amazon. That's why I said we've seen this movie many times before, and we know what happens. It just recovers and makes new all-time highs. Investors were rewarded for this risk that they took. But each one of these drawdowns was enough to test every investor's endurance. If you're not willing to stomach a double-digit drawdowns, you are less likely to receive double-digit returns. This chart here from Renaissance Macro basically outlines that it's oversold. Amazon shares are oversold. Can it get more oversold? Absolutely. In my opinion, this is another opportunity. I stuck to my discipline. Our July call was just that. You get out, take your profit. Now we have the opportunity to get back in, possibly sub 3,300 with the results that Amazon just produced. Like, don't hurt me with better prices. I'm all about that. All right. Thinking more macro at this point, right? Because we know earnings are growing very robustly. How sustainable is that? In my opinion, it's going to last and go into next year. I believe we're still going to see double-digit earnings growth next year. But while we're in this kind of Delta COVID variant, bond yield dropping, I could probably go on and on, environment that is causing some investor anxiety, and you combine that with the seasonal headwinds for the markets, a lot of folks are they're trying to attach a narrative that this is economically related. Well, since we've passed the peak in the GDP, possibly, the market is mean reverting to some degree. And that's why we've had this choppy price action over the last couple weeks, yet still making new highs. I think it's bunk. None of the hard data related to the consumer is showing signs of any significant slowdown. Like none. I look at consumption. I'm looking at retail sales. We only get the Census Bureau's retail sales data every month, right? But in between, on a weekly basis, we get the Johnson Red Book retail sales. Every week, comes out on Wednesday, I believe, yesterday. And as you can see here, on the bar chart here, we've re-accelerated once again. These are year over year. I mean, we had this same thing happening here. This was unsustainable. This is not sustainable. Don't get me wrong, folks. These double-digit teens year over year, Red Book Johnson retail sales are not sustainable. I know that. I'm not saying that we're going to see this continue into next year. What I am saying is that this lines up perfectly with the child care tax credits that just went out on July 15th. So we're seeing another leg of the consumption, of consumer spending, of retail sales growth. So in terms of have we hit the peak in the economic growth, it remains to be seen. None of the hard data suggests that we have. And these child care tax credits go through the end of the year, every month, qualified parents will be receiving for children under the age of 18, I think it's $300+ per child. Monies that used to go to childcare expenses are now being filled with these government transfer checks. Ultimately, that frees up disposable income for those families, which, they'll save some, but we're consumers. This is United States, folks, okay? We consume. We go to the store and we buy crap. Need it, don't need it, we buy it. The more money that we have, the more disposable income that we have, more we tend to buy. And it's showing up in retail sales. Another reason why I think, and this is a really good point that was made by Ben Carlson of Ritz-Holtz Management, is that we have consumers with we have households with still yet elevated personal savings. They're getting these child care tax credits through the end of the year. And there are households that are able to refinance at near record level mortgage rates. We hit 2.65% on the 30-year fixed rate mortgage in January. And then we elevated to just above 3%. Guess what has happened? As the 10-year Treasury has fallen from 1.7% back into the teens, the 30-year fixed rate mortgage has followed lower, down to 2.78 as of this week. Folks that didn't cash in on the refinancing before it got back above 3% on the 30-year fixed, they're able to cash in once again. And that basically, lends itself favorably to, again, disposable income. When you look at, mortgage, the average mortgage, the $200,000 mortgage at a 5%, which takes us back to 2018, we were just below 5%. 30-year fixed rate mortgage. So on a $200,000 mortgage, you were paying $1,000 a month. But at 4%, it was only $950, and at 3%, it's $840. You're talking about a $230 savings difference from 5% to 3%, and you can do it for every $100,000 higher in mortgage. These are huge savings, folks. And the best part about this is it's compounded. It's every month you're saving this money from $1,000 down to $840. Every month it's compounding. And people stay in their homes upwards of 10 years. So this is another positive force of disposable income. And again, some of it will be saved. A lot of it is going to be spent. With two big tailwinds here still, they're going to play out through the end of this year. So when we think about the market and how we're planning to allocate, do keep these variables in mind. When you hear that the market is at all-time highs and we need to be aware of a potential correction, that just goes without saying. We should always recognize, to the extent that we've gone as long as and as far as we have in the S&P 500 without a meaningful correction, that's commonplace to understand that we should be aware of, market breadth and how that may lend itself to, a bigger correction. But as I've said for many, many months now, this market needs a catalyst that will override the fund flows. Seasonality hasn't worked when it comes to potential bigger drawdowns. It just hasn't. It's because two of the major forces in the market, being liquidity and fund flows, have overpowered it. If there is going to be that bigger drawdown, the greatest chance it's going to have is here from August through September. And why? It is a summer doldrums. People are on vacation, and we lose a degree of liquidity through the summer doldrums into the fall period. So with that, this is our weekly State of the Market. Hope you guys have a fantastic trading week. Don't forget, this is our off week with respect to our weekly research reports. Safe trading.